Hello and welcome back to Dukascopy TV. Now, if you look back over 2012, you may have seen a multitude of negative financial news stories. But as we kickstart 2013, are investors becoming desensitized to crisis stories? Well, this, among other questions, is what I'm going to put now to Fabrizio Quirighetti, who is the Chief Economist at Banque Syz Co. Fabrizio, welcome to the studio.
Thank you.
So yes, focusing on that question then, has it reached the point where investors now look at negative news stories, such as the story, for instance, of Greece and its possible exit this year, we don't know, and just basically ignore that and are now going with their gut instincts?
Yes, there is a little bit of that, and in fact, because we are get used to bad news since 2008, we had many of them, and some other point to changes in the investor mind, such as the decision of the ECB to do whatever is possible to save the euro area, and the fact that the Fed is continuing to do a very accommodative monetary policies. In other words, central banks have removed somewhat the systemic risk of the end of the financial world. And for that reason, people now start to be more confident, I would say, in the future, and they don't look anymore only to positive news. That's the first point. The fact, if you remember, in 2011, you had each day +2, -2% in the market, and it was risk on or risk off, and you had no midways in between. If you look over the last few months, what you had on the market, you have days with the market basically flat because nothing has changed in the world, and so there is no reason to have big movement on the equity market. And so it means that we have moved in terms of return distribution from a bimodal world where you had only very positive or most of the time very negative news impact on the market to a more normal distribution.
So if we agree then that investors may be becoming more confident, what with hearing negative stories, the so-called fiscal cliff, Greece, Spain, Portugal, problems in Europe, for instance, how is this going to affect long-term investment? I mean, are we now going to see with this growing confidence investors looking at a much longer term or still perhaps maybe looking at the short term? Yes,
no, they will start to look at the longer term prospect. And in fact, the fact that we are so used to bad news, even the fact when you don't have bad news, it starts to be a good news. So you just have to have quiet market, and people now start to think more to longer term. And you can see that on both the equity investors and to bond investors. If you look at bond investors today, they are speaking about taking some leverage, perhaps invest in less liquid issues, in a smaller issue. So it's all kind of investment that you usually don't do when you have some risk in the market. And for equity is the same. Now people are moving from the big large cap to perhaps more smaller cap or foreign investment. And so it means that now investors are again thinking more to long term. But it's still a long process, but we are going in the right way.
Fabrizio, if we're looking again at this idea of long-term investment and growing confidence amongst investors, some analysts I've spoken to have said that this year should be a good year for the stock market, for instance. Let's just sort of focus on the bond market, though. Will this change in attitudes amongst investors shake the bond market as well?
I think we will experience both a positive year for equity and bond market. You cannot have a very good year on equity with a very negative year in bonds market in the current environment. Why? Because if rates rise or increase too high, it will put in danger, in peril, the economic recovery. And at that point, people won't invest anymore in equities. So to have a very good year in equity market, you should not have a so bad year in bonds market. You cannot have both very good on equity and very negative in bonds.
So they have to be both doing pretty well.
Exactly. My basic view is that interest rate will remain about the same level as today. So it means about 2% for a 10-year US Treasury note and about 1.7, 1.8 for our 10-year German bond, and less than 1% for our 10-year Swiss government bonds. Obviously, you will have some volatility, and it may increase a little bit further as economic news improve, but at the end, you will have a comeback because you will still have some appeal of long-term bonds if cash rates remain at zero, because having for a bond investor, it's better to have a 2-year coupon with a 10-year bond than zero with cash.
Okay, Fabrizio, well, we've talked a little bit about investor attitudes. I'd like to throw something at you though now, and that's the Dukascopy question. Your investment choices. We've got a list up here of asset classes. We've got real estate, equity, bonds, gold, cash and oil. If you had $1 million, where would you put that cash?
Definitively on equity. For at least 4 good reasons for me.
And what are those?
And the first one is that's probably the most liquid asset class. The second one is the least overvalued one in the current context, so it's a bit by default. It has dividend yield that are much higher than the coupon that you can get on bonds. And last but not least, that's the best hedge against inflation.
Fabrizio, thank you very much for coming into the studio today.
Thank you, Thomas.
That's all we've got time for on Dukascopy TV today, but we'll be back next week with further updates and exclusive interviews on a whole variety of financial topics. But until then, have yourself a great weekend. Goodbye.